Assalamualaikum. Let's start the discussion over the ethics piece. So with respect to the ethics, ethics is something which is a compulsory feature for every professional exams, right? And with respect to ATX, ethics is something which is like always in section A for 5 marks. So we should give a respect accordingly, like this area would be covering the 5 marks from the exams. Ethics in the ATX is nothing new. So all of the fundamentals remains the same as previous, like ethical principle, the possible conflict of interest, all of these things are same, right? But we need just to translate all of that stuff with respect to the ATX, how it would be translated into the ATX, into the taxation universe. Previously, the ethics was with respect to the auditor, with respect to the, for example, a CFO, business strategist, etc., etc. But here, the ethics would be with respect to the tax advisor, tax consultant kind of stuff. Okay. So if we go start with the ethics philosophy, professional code of ethics. There are professional code of ethics if you are gaining new employees, if you are having conflict of interest, if we observe some of the HMRC errors with regards to the tax avoidance, evasions, and some towards the money laundering regulations. Okay. Normally 5 marks, fine. A most common issue with respect to ethics and ATX. If we are having a new prospective client, what should we do? In this type, we will be having a new client and the requirements will be that for factors we should consider before accepting this potential client. So this is one of the very normal feature for a client to switch the tax advisor. And if a client is switching the tax advisor, what should the tax advisor do? The factors which needs to be considered are as follows. Like the tax advisor must obtain evidence of client's identity, the primary business address and registered office of each of the client, proof of incorporation, details of directors and shareholders and the identities of those persons instructing the firm on behalf of the client. Moreover, what we further need to consider, we must have regard to the fundamental principle of professional ethics. This requires us to consider whether become tax advisor to prospective client would create any threats to compliance with these principles. For example, integrity. We must consider the appropriateness of client attitude to complying with the laws and disclosure of information to HMRC. Professional competence. We must ensure that we have the skills and competence necessary to be able to deal with the matters which may arise in connection with the prospective client. If such threats are identified, we should not accept the appointment unless the threats can be reduced to an acceptable level via the implementation of safeguards. We should contact client existing tax advisors in order to ensure that there has been no action by client which would prevent the acceptance of the appointment on ethical grounds. For example, if the client is not properly filing its tax returns previously, we must carry out a review in order to satisfy ourselves that client is not carrying on any activity which may be regarded as money laundering. If we observe any kind of conflict of interest, conflict of interest can occur in the following situations where a member acts for a client and is then asked for another party in a transaction, acting for both parties in divorce, acting for the employer and their employees, where the advisor may benefit from the transaction. It may be acceptable to act for both parties as long as following safeguards are put in place. Potential conflict of interest should be pointed out to the all relevant parties, like disclose them that this could lead to a possible conflict of interest. Consent should be obtained to act for them. The firm must have clear guidelines in relation to the confidentiality. should consider the need to use separate teams for each client. Alternatively, the firm may consider acting for just for one party, not acting for either of the party. And obviously that depends upon the firm itself. HMRC errors or tax irregularities. If a member becomes aware that the client has committed a tax irregularity, they must discuss it with the client and ensure that proper disclosure is made. Possible examples would include not declaring income that is taxable, claiming reliefs to which they are not entitled, not notifying HMRC when they have made a mistake, giving rise to an underpayment of tax or an increased repayment. Where a client has made an error, it will be necessary to decide whether it was a genuine error or deliberate or fraudulent, because that thing decides the error penalty accordingly. Once an error has been discovered, the member should explain to the client the requirement to notify HMRC as soon as possible and the implications of their not doing so. Okay. If the client still refuses to take full disclosure, the member should cease to act for the client, because in such situations, the tax advisor is also considered as part of the money laundering. It must be also then write to HMRC informing that they have ceased to act for the client, but without disclosing the reason why, due to the confidentiality. Must then consider their position under the money laundering regulations. Tax avoidance or evasion. Tax evasion is unlawful. A taxpayer who dishonestly withholds or falsifies information for tax evasion purpose may be subject to criminal proceeding or suffer civil penalties. Tax avoidance is the use of legitimate means to reduce the incidence of tax. However, the courts are wary of the schemes or arrangements, the sole purpose to which is to avoid the tax. Money laundering. All business within regulated sectors must appoint a money laundering reporting officer within the firm. Where a report is made, the client should not be informed. This may amount to tipping off, which is an offense. Okay. Some general discussion about the concept of GAAR, which is abbreviated as General Anti-Abusive Rule, which are made by HMRC to combat tax advantage arising from abusive tax arrangements. Arrangements are abusive where they cannot be regarded as reasonable course of action. For example, where they include artificial steps or are intended to take advantage of deficiencies in the tax legislation. So it's like creating a series of transactions, creating a wheel to conceal the original legality of the transaction, original substance of the transaction. All of such things are examples of GAAR. If the GAAR applies, HMRC may respond by increasing the taxpayer liability, accelerate tax payment or delay refund, and ignore artificial steps in an anti-abusive scheme. A penalty of 60% of tax advantage obtained through the GAAR can be charged. So that is the maximum side. There is a civil penalty of up to if the tax agent is found to be involved in dishonest conduct, then what will be the implications? There is a civil penalty of up to 50,000 for dishonest conduct of tax agents. In cases where the penalty exceeds 5,000, HMRC may publish the details of penalized tax agents. With agreement of the tax tribunal, HMRC can access the working papers of the dishonest agents. So that is the basic, very basic, but approximately like 90-95% coverage of the ethics related area. If you guys walk through with these notes, with these concepts properly, you will be able to solve vast majority of the ethics related questions from your past exam paper, exam mocks, and from the exam kit. Thank you.